Hello, it's Cryptolyze. It is a pleasure to see you again on this Saturday, 29th of July, 2023, and I hope you are well. Today, it's going to be a bit of a special show. We're going to take a step back. We're going to take a step back from the halving that's happening, from what happened, from what's going to happen. The goal is to offer you a projection, not over 6 months, not over 1 year, but rather over 2 years, to fully understand the games that are being made, whether at the BTC level, whether at the party level, whether at the macro level. We are going to take the time to dissect all of this and give you my vision on what will happen next with cryptocurrencies, particularly BTC. I'm not going to talk about narrative. I'm going to talk purely technical and fundamental structural at the level of BTC, because let's not forget it's BTC, which is leading the dance, and it's BTC, which will start the next bull run. We'll start by talking about halving. The halving is very important. It is the moment when we will see the rewards offered to miners halved. So overall, we are having the generation of BTC. We are having the downward selling pressure from miners on the price of BTC. It's very important, and it has always been a very significant event. So whether it's self-fulfilling or whether it's actually done, you also have to understand what is happening. And on this, I'm going to offer you an analysis, which will be a little different from what I usually do, in which we will combine fundamental, pure technical, and at the same time consider BTC as a society for good. Understand how it can work, how it should work, and you will see that it is a little bit identical. We will find ourselves in more or less patterns. We will already start with the technical analysis. Quick technical analysis, we are therefore on the total monthly index of BTUSD, all in logarithmic form. To have a good vision, we have in yellow the lines which correspond to the different halvings which were carried out previously, the 3 previous halvings, and in white punch, approximately in April-May 2024, we will have the halving precisely of the last, the 4th of the year 2024. So which is going to be really important, which is awaited by a large part of the community as being the start of the bull run. Historically, this has always been the case. So more or less, it's not the day of the halving that it happens. When we look, it's generally a few months later, and that's always been a little bit the case, with potentially 2-3 months late. But that prevents a schematic from being put in place. It's not necessarily the halving itself. It's everything that's happening around it, yes. But on the other hand, we have, it's true, a structural dynamic at the halving level that we will see later with the real decrease in the number of BTC which are offered to miners. So for the technical part, we will already look at Ishimoku quickly, which allows us to have a long-term trend. It is a very good indicator which allows us to structure trends and flows, management of trend flows, and we see that systematically before the halving, we have gone under the Kumo and working below the Kumo before having a break too. Moreover, it is very interesting to see that structurally, in terms of the implementation of Kumo, we always have flat Kumo, acceleration, flat Kumo, acceleration, flat Kumo, with phases of acceleration, with phases of neutrality, and which is exactly what is happening. And we see that we systematically pass below the Kumo and come out. We pass below the Kumo and then come out again. Same here, we go under, we cross, and therefore we will come out. Clearly the exit period acceleration, so we can clearly see that it always happens when the Kumo breaks, and it systematically happens after the halving. This implies that where we are currently, which is a somewhat particular zone because we are currently already under the Kumo, we are under a resistance which is relatively strong, which was the support of this rupture here. Okay, so we will come back to this pattern here that we have there, which is very important, which gives us indications, whether technical or fundamental. But we are fighting on this resistance, and we are passing on the Kumo. So yes, we have a little bit of margin. We can go for the 35,000, 36,000, which are precisely the upper zone of the Kumo, or even enter a little bit into the Kumo before making a break. So we could have something done like that before leaving again. What does that imply? This implies that we can have a form of ranging during the 8 months, because there are 8 months which separate us between 25,000 and overall, come on, let's say a little lower, 40,000, on which we can have a ranging zone and neutrality at the BTC level. We have to take it into consideration, even if we have potential risks. So that's a little bit special because it's really the COVID crash, but we have particularities where we can do falls low enough to go and retest. But let's admit, we're going to break lower, we're going to retest the 18,000, 20,000. It still remains relatively safe. We can say that we are going to say, come on, we are going to be very wide. We are going to say that we have a ranging zone between 20.0 and 40.0, which is going to be the box in which we are going to wait in the next 8 months before setting up the halving and then the next bull run, which will arrive, which And what is interesting is that this part is at the same time reinforced. When we look at the EMAs, we see that we systematically accompany the IMAs with a batch which is carried out where we go below, we reaccelerate at the rise, we go over it again, then we lean on it again to reaccelerate. This is exactly what happened with a dip, which was still relatively strong, but then we went back over it and we are pressing on it. So I think we're going to stay in something like that before we can leave. And so we have a real confluence that's taking place, a confluence which is at the same time consistent with what we are seeing in terms of the RSI. In relation to the history that we may have had. Once again, be careful. It is not because we have a fractality. It is not because we tend to look in the past for elements to understand the present and anticipate the future that it is happening. Obviously, these are elements that allow us to come into contact with others to see if we have elements of resemblance, if the market is identical or not. We're going to stop there because I gave you a sentence that is very important. Is the market the same? Yes or no? Very, very important to understand this. First, we're going to do a little macro point. Is the market the same compared to this entire period? Clearly, no. There, we are in a phase where we have high inflation, we have an increase in rates, we have a reduction in liquidity. Very important to take into consideration this reduction in liquidity, and I'm going to address precisely this notion of upward acceleration, which we call the bull run and the correlation it has with liquidity. And on that, I'm going to base myself between one, my technical analysis, my knowledge of the market, and two, something I presented to you in a video about 15 days ago, which was BTC at $1 million, where I presented to you the theory of the rational root, who is an analyst specialized in on-chain modeling, particularly specialized in BTC, who showed us precisely one, the correlation between liquidity and supply, which is in the process of to decrease, and the valorization potential of BTC. So to keep it simple, I'm just going to go over certain points, and you'll see we'll correlate all of that. The first point that we will have is the notion of global liquidity, implying the totality of the liquidity which is currently available in relation to history. And there it is very important to compare what happened at the level of halving 2, at the level of halving 3, and precisely the presence of this very, very strong increase in equity and the decrease in this implementation of equity, although we have a real structural increase. But that does not prevent us from currently being in a share of equity which is very, very, very high and which is much higher almost. We are not going to be twice as much, but we are going to be almost 60% more than the previous halving. And when we look at the increases between one and the other, between the different halvings, we had taken roughly a little more than 10 trillion. Okay, between the two halvings. That's not the case. We are at 71, 72, almost here. Excuse me, at 79. Okay, and where are we? We are almost at 95, almost in the centrans, so we are in a very significant increase in liquidity. Clearly, what is it characterized by? This is characterized by a liquidity potential that can enter the market. Currently, why is it not entering the market? Understand that we have an increase in rates that is being made. Apart from the difficulty in generating liquidity, in generating loans, it is above all a call to invest your money because quite simply, nothing is more profitable currently than American Treasury bonds for a rate of risk, which is really very, very low. So as long as we have a high rate level, there is no point in seeking risk elsewhere because we have an almost guaranteed risk-free return. Because let's not forget that the Americans and therefore the USA has the printing of money, which is almost infinite, and that will not change for the next 10 years until, in fact, we have a BRICS currency which can compete. It will take time. It will not happen overnight. We have the beginnings, yes, but we have to plan for the long term. At present, the US dollar remains and will remain in the years to come, at least in the next 10 years. Still the reference currency and the printing press that will work best. That being said, we have behind here a pivot which must be made. That is to say, we know that we will certainly have another increase in September. If you watched yesterday's daily, you understand this that I'm talking about, but we is definitely going to have an increase in September of 25 points. But in the long term, we will remain at a relatively flat level. What does it mean? This means that the price increase will remain between 5.5 and 5.75 for a certain time. And this temporality, I think it will be in 6 months, 7 months, 8 months before implementing a reduction in precisely these rates. What will this reduction in rates lead to? Will lead to a reduction in the interest in leaving money in U.S. bonds and therefore seeking profitability, therefore going seek performance and therefore redistribute funds on risky assets, on stocks, on the back? Why not cryptocurrencies and all that follows within particular potential ETH spot, which could arrive by then if they are not refused? Even if they are refused, I am sure that there will be a new demand with new players who will come in. It is certain that it is a question of time before there is a spot ETF which arrives on the market, because there has a request. And if there is a request, there will be behind an achievement. We will respond to this request, and it will be done in one way or another. But therefore, the temporality is rather consistent with the notion of halving here. And it is very interesting because when we understand this notion of liquidity, it implies that all this liquidity is waiting to flow elsewhere because there is nothing more profitable with a guaranteed risk precisely. U.S. bonds, and that's why we just have to say to ourselves, okay, what am I going to wait for in terms of macro? I'm going to wait for three things. I'm going to wait for one, the fact that we have the end of the rate increases. Secondly, that we have finished the delay in the fall in inflation, therefore through high rates, which will ultimately initiate a pivot, and therefore a third phase, the pivotal decline, and the pivotal decline, which may take a few months, which can take 5-6 months before being done, and in which the more the reduction in pivots takes place, the more we will have. In fact, we will have, for example, here, I will trace to give you an idea, the reduction in interest rates, which will take place, something like that. And we will have the increase in BTC, which will happen like this, with a structural liquidity outflow. And so for me, it's really the event. And we see that we have a form of confidence that is being built. But the question is it enough? Is this enough? Is this what we are waiting for to go further? And is the halving that we already had previously third, which had performances that were much lower than what was expected? Okay, when we look from top to top of the previous bull run compared to the one we had. So 253%. Okay, the previous one, you will see the difference. We are in elements which are not even comparable. 1,400%. And on this, there are two theories which are clashing. The simple theory of markets, which is the more liquidity we have, the less performance we have, the less return we have, therefore which is entirely logical and which applies almost to all classic and structural markets, in which the more we will have liquidity, the less we will have no valuation, but the less evolution we will have in percentage from one bull run to another. So we smooth volatility through liquidity, and this is exactly what is being expected. It would imply in this case that we would potentially seek a 100, 110, 120. When we just look with a Fibonacci extension, we do the lowest of the bull run before the second halving, up to the top, we recover. We see that we did here what we did 2,618, a little bit more than 2,618. Okay, well at that point we're going to do the same thing here. Okay, previous we considered that was our lot. Here we are not going to look for 2,618. We will look potentially between 1,1 and 1,618, therefore, which brings us between 90,000 and 1 lock 20,000, 1 lock 25,000, if we take into consideration the decrease effective returns. Yes, on that we will approach this notion of reducing the number of BTC available with the provision of liquidity. It will happen. Don't worry, it will be approached in the following way, which will be the one a little bit that I presented to you 15 days ago, precisely on the idea by rational root. Rational root goes even further than that. It will, in fact, address a consistency, which is the notion of the Ethereum holder. So LTH means that people who own BTC and who do not sell it and who hold BTC for the long term. And we see that we are in the levels of 2015, so which do not correspond to halving 2 and which do not correspond to halving 3, okay? So we are currently at very, very high levels for holders. We have more than 73% of long-term holders. And it's really very important because it implies that we have a shift that is taking place. Keep that in mind because we'll come back to it. Because the other thing that's really important is the notion of the hold model that defined it. Hold model being precisely the representation of people who hold BTC and which is highlighted alongside what is available as BTC for sale. What does that imply? This implies the saleable mass of BTC. So everything that is not lost, everything that has not moved, finally, everything that has moved in the 2-3 years, everything that is capable of being saleable, and that was not sold during the previous bull run. And that is very, very important. And we see that the total supply, which is set to decrease through the different halvings, which is entirely logical. We know the strength of the halving in the sense that the more we move towards it, the less there will be BTC, which will be available on the market. So the more we will have a supply which will decrease, and they consider that the halving 3 was the biggest gap between the representation of the holders and the presentation of the total supply. and that the two are bound to become restricted over time, and that the halving 4 will be the starting point of this reduction in the gap between the two, therefore implying a rarity of the BTC available for sale. And I'm not talking about a rarefication of the number of BTC, because that's always 21 million in the long term. And it's always a definite increase compared to the halving. I am talking about the number of BTC available for sale. And it's very important because it implies that we are in the process of shifting something. We are in the process of shifting the generic representation that we can have on a financial market where volatility decreases in relation to liquidity. That liquidity leads to a reduction in volatility. That liquidity leads to dilution of the number of shares. And that is very important. In a traditional market, we can issue new shares, we can dilute shares, we can subsequently increase the capital. Can we do the same thing with BTC? I want to tell you absolutely not. We cannot. And this is also the case for Ethereum, for example, in which we have a market cap, which is also fluctuating and disinflationary. But that's yet another subject. What I want to bring you here is that, okay, we have this representation of the real model where we have the two which are confronting each other. I want to tell you we're going to make a mix of the two. We're going to make a mix of the two because the two have a coherence. That is to say that behind BTC, we have an industry. We have miners who are not small industries. It's not Gene Kevin who is in his garage or in his basement to put precisely ASICs to mine BTC. No, we are really in a heavy industry with millions, hundreds of millions of investments behind it, even billions of investments in funds like BlackRock, like the big funds, are buying shares of these factories. So we have a real business that is being created. We have entrepreneurs behind it, factories that are running. And what do these factories produce? They produce BTC. And so that means that it is linked to the price of BTC and the number of BTC. So it's simple, is that every time they create a block, they get back 6.25 BTC right now. 6.25 BTC, that's not all. At each block, there is a miner who is designated to recover this, to validate this block. So that means that every 10 minutes, we have 6.25 BTC, which are given. And that actually represents their average turnover. It's very simple. They will say, if I have 25% of the computing power, that means that every 10 minutes, I have a 25% chance of winning. 6.25 of BTC. And representing that, it implies that the halving, which is going to happen, will be a division by 2 of their turnover. Very, very important, this division by 2. And when we look at the BTC mining indicator, which I have already explained to you several times, which represents the state, in fact, at the level of the BTC, finally at the level of the mining of a BTC, and therefore it is very important because on this, it correlates the increase in the difficulty of the network, therefore implied. The number of actors who enter this network, the more it goes up, the more there is a significant number of actors who are present. So that means that it only goes up. And even in this period of horrible descent, increase in the number of miners. And it's very, very important. And when we look at it a little bit more in the reports that I gave, so I gave something that is relatively simple, in which I took a S19 Pro, in which I defined 4 centimes in kWh, which is all in all relatively low. I'm sure that the majority of miners don't have that price. And we see that we're being led to a price of 25,000 already, okay? 25,000. It seems completely coherent to me at the moment. Although we have people who are lower, who will be in the 3 or even in the 2 in some, we can reach 12,000 directly on the level of BTC, but that's a minority. The majority are when we also smooth out the fixed assets, rather between 4 and 5 centimes per kW. That means that we're going to divide by 2 during the halving satimation rate. Okay, so it's dividing by 2 what they're going to receive. So we're going to simplify, we're going to put 3.15. Okay, so we can put it. And you will see that it is not at all the same thing. We find ourselves in a BTC, which is already in its current state at 50,000. This means that the production cost after the halving will be $50,000 to create 1 BTC. And that is really, really, really very important because it means that this entire industry will be in negative if we don't have a revaluation of BTC. And yes, there may be people who will unplug their machine, but that doesn't mean that when we look at the history. From the evolution of this rate, we see that it has always been growing. Yes, sometimes we have periods of zoning, but it has always been growing. So there has never been a stop in that regard. There has never been a stop. There has always had an upward acceleration, especially when we take into account that we have additional energy valorization. With what happened with the break between the world revolved around the USA and the world revolved around China and Russia. With the BRICS, we have this rupture and this dissonance which is taking place, which favors energy inflation. So it would not be totally aberrant to see the increase in real costs at the level of the average on the KWH at 5 centimes. Why not even at certain times at 6 centimes? Yes, we will perhaps have a reduction which will take place, but we can very, very quickly arrive at a cost of BTC which will exceed 50,000, go into 60,000, 70,000. And that implies that we will have to have additional valuation because we have an industry which will reduce its turnover. And so that means that there is no other choice than to have a valuation of BTC or an effective reduction in the number of people who are present on the network. And that I think it will happen on its own naturally, as we have already seen in the various halvings, and we will have a valuation of BTC. And when we put the two together, that is to say the reduction in the generic BTC supply plus the industry behind it, we say to ourselves that yes, the target that we can have. Currently, it is totally different from what we have known. That is to say, we will not go with this idea of perhaps 1,20,000. It is possible that we will go much higher thanks to this new dynamic that will be put in place. There's another theory that I'm going to present to you which is added on top. I'm just going to show you something. We are going to put it back in the vicinity of 4, no longer at 6.25. We are going to put it back before the previous halving, that is to say at 12.5, and in which we were not in these same themes. We did not have these machines which were available. We had something which was a little less efficient. We were more in the vicinity of 4.2 at the era. So we're going to put back something like that, which actually represents the cost of 1 BTC historically with this halving there. Okay, during this period, during 2017 to 2020, and we're going to look at the evolution, and we see that we never actually went under it. We always went well above with a breath, with just perhaps a touch on a very, very harsh effect, which was the COVID impact. And even if we make the same game, I won't do it there, but when we make the same game, I invite you to do it, between 2012 and 2016. And historically, we are always in this approach where the gap, in fact, we could even say that the gap is narrowing, but we have a form of anomaly at this year's level when we look here. I'll put it back. See, the 6.25, we're going to do things right. 6.25, we're going to bring back the 3.5. I'm nice because in reality, it's not even 3.5. I'm going to put 3.8 because that's more the general idea we have. And we see that we had a smoothing which took place where we went below, and we accompanied the increase in the price. So we accompanied the difficulty of the increase in difficulty by the increase in the price. And it's very important because here we are in a different approach, and we can ask ourselves the question, how has this year been different? And on that, there is a representation which is precisely a mix between rational root and the analysis that we can do on it, which comes from this LTH. That is to say that over the year we had, and even the previous year, we had LTHs which were very, very low. And we finally find ourselves in an LTH which is relatively high. And even to go even further, halving 3 was the lowest point between the supply, which is liquid, and the supply, which is available. So that implies that it was a bull run, special. And was this bull run also technically special? That's a bit of what interests me, and we're going to end on that. So as not to make a video that's too long, I always have the habit of failing, even one could say, of talking a little too much and am spread on this kind things. But we still had a bull run, which was a little bit different in the sense that we had a break and a reacceleration. This is the first time that we have this. This is the first time when we look very easily and very, very far away. We see that we have an acceleration here. Okay, acceleration, yes, force of ranging of neutrality, but it's not a breakout. And there we see an acceleration, and then we have the structured breakout. And here we are really in something different also in terms of temporality. When we look here from this halving until precisely this first top, we were at 10 bars, so that is to say at 10 months. And then where were we? At 17 months, okay? Okay, we refine these figures the same. We have up to the top. 16 months, okay? There we're going to do the same, halving to the top. We return to the previous cycle once again. Very interesting to see that because you will see that we still have elements. What do we have? We have on the top 11 bars. So systematically, here we are in the representation of the first bull run that I presented to you. Second acceleration in the representation of the second bull run. And is this breakup a real breakup? Isn't this something that is a form of anomaly? Shouldn't we have had a bull run this year, which should have been much more powerful and much stronger? Wouldn't we have had something that was much less digressive in terms of yield? That is to say that when we look at the evolutions from bull run to bull run, Yes, we know that we have yield, a percentage of increase which decreases. But it is true that the break and the rupture which was carried out in the year 2021 is different. In fact, breaks the model that we could have. And so we can ask ourselves the question of, is this break here really representative of a structural bull run? That is to say, is this movement that was made here, this bull run, not below expectations, and will it not be made up for in the previous bull run? Clearly, there is a whole thesis that has been built around this, with targets potentially looking above 1,50,000 for more aggressive progression. Personally, I tend to tell you that whether through this technical or fundamental year, nevertheless, we are sure that we will have a bull run which will still be different from the others this year. Well, next year, when that to arrive at, for what? Because we are going to have a shift in equity. We are going to have a contribution to structural equity, which is going to be strong. We are currently in a regulatory phase, which is arriving. We are potentially next in a phase where we are going to have institutions of the size of BlackRock. It is not small institutions as historically. It is something which is much bigger, which is clearly interested in the mining industry. That is, this is the case. It is confirmed. And at BTC, through a financial product, given that we find ourselves on ETFs, which are in the process of arriving, so we have a shift that is happening and we have liquidity that is waiting to flow and liquidity that has never been so high. So at some point, I want to tell you that yes, it is very likely to find yourself on a bull run, a top bull run that exceeds what we had defined as a target. We must take it into consideration. And it's not for nothing that I'm talking to you about it now. Quite simply because yes, we tend to let ourselves be drowned in noise. And through everyday life, I strive in any case to give you a vision in relation to the noise that we can have. But it must keep the long term. What does it matter if we ultimately trace back to 22,000? What does it matter if we trace back to 18,000? The ultimate goal is that at some point we will exceed the ATHs, and that this ATH we will certainly fetch more than $1 lakh and even 150 or even more. And it's the finality that counts. Once again, we don't forget, it's patience that counts. It's resistance. It's resilience. I mean, as I told you, from the moment we made the break here, at a time when we were here, I also told you that these are purchase prices which are not never seen before and which are very important to be able to structure. And this is also the case here. Remember, the people who were here said there was no point in buying at $13,000. And I remind you that currently we are at 29,000, 30,000, and that we had a top at 70,000. Once again, take the time, understand that you have to take the time to be able to evolve. And that is really the very essence of investing. It is the very essence of trading. I hope this video wasn't too long and that you didn't give up. If that's the case and you're still there, leave me a little comment and a little thumbs up to tell me how much you liked, hated, or nothing at all. It always makes me happy to read you and to respond to you systematically. We'll meet tomorrow for a video on BitTensor, and if you're ever interested in following the two videos, which were very important on one, my vision in the 6 months, and two, the BTC at 1 million, I'll put them there for you, and we'll meet 8:30 tomorrow morning for the TAO analysis.